All right, here we go. The Employment Cost Index report is coming out in about 10 seconds. We are looking for a survey of 1.1. This is probably going to move the stock market today. We're looking at 1.1 or less. 1.1 or less. Anything above would probably be bad news. We need to see employment costs go to 1%. Let's go. Good news, good news, good news. Good. Oh, that's great. That is below expectations. Again, the prior report was 1.2%. Now we're at the survey for this report was 1.1%. We just got 1%. Thank you. Oh, this is actually really great. We want to see a softening in employment costs. This is probably the most important report going into the Federal Reserve meeting. This is very, very good news. We are seeing now the NASDAQ going from negative to flat. You've got only a slight boost on certain stocks. It's not the most widely reported piece, but I wouldn't be surprised that as the day goes on, this actually ends up softening the Federal Reserve stance, and this could end up boosting stocks today. So I'm very optimistic about the employment index report coming in at just 1%. This is great news. And it's something that even Nick T reported is something that the Federal Reserve is going to be paying attention to. And that leads us to obviously needing to have an inflation discussion, which let's go through an inflation discussion and see what some of the risks are for inflation and the market. First, I will just highlight the importance of ECI by showing you Nick T on Twitter saying Fed officials have said they pay close attention to the Employment Cost Index, a comprehensive measure of wage growth. Q4 figures just out aren't likely to change the outcome of the FOMC's meeting, which means we're still going to be getting the 25 basis point hike, but it could be important in shaping the outlook. Well, folks, Nick T, often deemed to be the Federal Reserve's mouthpiece, is basically telling us, hey, Jerome Powell might be nice to us at the Federal Reserve meeting tomorrow, which is quite bullish, but it does stand in the face of some not so bullish information. And what I'd like to do is, in the most unbiased way possible, try to go through some things that are good news, some things that are bad news, and just realistic information regarding inflation. I'll also provide you insight into what's going on with what layoffs tell us in terms of where in the recession cycle we could be. A lot to cover. Let's get started. The first thing that we have to remember is we have seen a deceleration and a reduction of inflation risks. However, there are a lot of companies that are reporting dangers to us. For example, Procter & Gamble and Johnson & Johnson both reported that inflationary pressures are still elevated. And if anything, they are worse on a month-over-month and week-to-week basis at the beginning of 2023. But they do give us hope. They give us hope that by the second half of the year, we could actually see those inflationary pressures subside. Now, that's a really big deal because it's also similar to what now brand new reports out are telling us from Whirlpool. Whirlpool expects to see raw material costs provide relief in 2023, and they're already starting to see material cost reductions. So while we're getting this sort of initial bad news that, oh no, costs are still running high, now more and more companies are reiterating inflationary costs seem to be coming down. In fact, Nick T, the Fed's mouthpiece, just posted another piece saying Whole Foods asks suppliers to lower prices as costs ebb. The grocery store chain says it wants price tags to reflect easing inflation. In other words, Whole Paycheck, in other words, Whole Foods, is suggesting, hey, it's time to start reducing prices, which would actually be disinflationary or potentially deflationary. One of the biggest complaints that I get every time I talk about inflation potentially easing is individuals tell me, Kevin, that's great that Whirlpool and Procter & Gamble and Johnson & Johnson are starting to see some of their costs come down, but when are they actually going to reduce prices for us? Because when we go to the grocery stores, when we go to Target and we go to Walmart and we spend money, we're still spending a lot more money than we used to, and it's a pisser. And it's true. You're totally right to be pissed. But the good news is, finally, the companies are starting to wake up and realize, crap, we're going to have to reduce prices and pass these benefits on to customers to actually help boost retail sales again. Retail sales would also include discretionary sales. That's usually where your margins are as well, right? Your margins for Walmart or Best Buy are going to be on some of those discretionary things. It's not the one product you're going in there for because you need it. You're going in there because you need, a USB cable. Best Buy doesn't care about that. They're trying to get you in the store. So you go buy a TV, a new computer, an Apple computer so they can get their commission, or you go buy a washing machine and then you use their higher margin Geek Squad or their services, their install services to go install that for you, right? And then sell you warranty plans and insurance plans, and those are extremely high margin. Those are like 90+% profit, right? So, or sell you gift cards, which most people don't redeem their full gift cards. So companies want you to come into the store. But the problem is people have been so squeezed and retail sales plummeted last month in December, especially when you adjusted for inflation. We had a horrible retail sales report with downward revisions for the prior month. Companies are starting to realize we need to drop prices, otherwise people are going to stop spending. Now, this is a good news. This is very good news, I think. I mean, listen to this. Whole Foods is asking suppliers to help the retailer bring prices down on packaged groceries as inflation moderates. They want to bring down retail prices in its store aisles as their own costs start to decline. As food suppliers have raised wholesale prices, citing higher transportation, labor, and production costs, supermarket operators say they have passed those increases along to consumers. This was previously, as prices have increased. After more than a year of price increases, shoppers have been cutting back on purchases, which is what I've just described, buying cheaper versions of groceries and seeking out deals across supermarket aisles. Some people, I actually used to do this when I had no money. I would look at the circulars to see where grapes were on sale, like who had the best sale on grapes. And I have a certain area where there's Trader Joe's would sell grapes for say $2.99. Vons would sell grapes for $3.99 a pound, and I'd hop on over and go to Ralph's and get them when they had the 99-cent per pound special, and they had like a lot of grapes, So, some people argue, hey, was that really worth your time? Look, back then I was working for $7 an hour. The answer is yes, it was worth my time. But the point is, that's what people do when they don't have a lot of money. It's very normal. That's what I did as well when I didn't have a lot of money. We know our customers are weighing the impacts of inflationary pressures. The company has worked over the past year to absorb rising food costs, offer new promotions, and work with suppliers. Whole Foods' rate of price increases has been lower than the industry average. Yeah, probably because you started a lot higher. The spokeswoman said, adding that the chain has lowered prices on some items, including cereal, bread, and sparkling water, and the company is committed to ensuring that prices reflect easing inflation. Now, this is great. Overall, inflation is starting to cool. Prices of fresh fruits, fish, seafood fell in December from November levels. Obviously, we still have issues with things like eggs. Doesn't help that apparently an egg manufacturing facility burned down in America. That hurts. So certain things are clearly still hotspots. But look, yeah, we are still seeing some strong indicators that are getting stronger and stronger, fortunately, that inflationary costs are expected to plummet. And that's good. That's very good, especially if those benefits get passed on to consumers. Now, while inflation is decelerating, there are red flags. One of the biggest red flags is what some folks are calling the potential for a second wave or a second chapter of inflation. This is what Michael Burry's been warning about. Michael Burry's taken it a little step further. He suggests, look, the Fed's going to ease, the Fed's going to pause, then they're going to reduce rates, they're going to cause another wave of inflation, and boom, we'll be right back to where we started, another disaster where the markets have to fall. I personally don't necessarily agree with that assessment, but that's okay. We'll leave my opinion out of it for right now. Another second chapter version of inflation, though, is a concern that in some areas outside of the United States, you're actually starting to see inflation surprise again. For example, the Spain's Consumer Price Index report just came in at 5.8% versus an expectation of 5%. And this is suggesting that in some emerging markets, we're starting to see inflation become synchronous throughout the world over time, that higher prices in one country lead to higher prices in another country. And the implication of this could be that eventually, as we see inflation go through a second chapter in the rest of the world, we could see upside risks to inflation in America. Some of those upside risks to inflation in America might be that medical services could jump. Medicare payments will increase at their highest rate in 14 years. That's already expected. We see the expectation that maybe rents or owner's equivalent rents could stay higher for longer. that, yes, used car prices are going down, but if that decline goes away in February, which is a 5% weight for inflation, is it possible that other aspects like rent staying higher longer or medical services staying higher longer or rising could actually lead inflation to miss to the upside? Especially with the fact that in January, we get new CPI weights, which we won't see until the February report on inflation, which we'll look at the schedule of releases for when we get the January report of inflation. We get the January report of inflation on February 14th, so mark your calendar for that. But the question here is, how will those new, that's Valentine's Day, by the way, how will those new weights affect how inflation is calculated? Especially since we're moving from a 2-year weighting measure to just a 1-year weighting measure. That's likely being done to get rid of the 2020 pandemic distortions. That's putting on the best case scenario here, not the tinfoil hat scenario. Tinfoil hat scenario, of course, being, of course, the Bureau of Labor Statistics is going to manipulate the data to make inflation look like it's artificially lower than it actually is. That's the more tinfoil hat direction. But anyway, the concerns are that we could be facing a second wave of inflation, not just because of emerging market risks, whether it's Spain or other countries, or medical care services stay higher longer, rent stay higher longer, used car prices stop falling, which hurts with the deflation fight or disinflationary fight. But then you've also got the Chinese reopening. Now, we've talked about the Chinese reopening ad nauseum on the channel, but I'll just give you the quick bottom line. The Chinese consumer is only about 32% of the Chinese economy, compared to 70%, that is the consumer of the United States economy is 70%. So the consumer makes up about twice the inflationary pressure in America than it did in China, or does in China. And so this idea that the consumer going back to spending and traveling is going to drive substantial oil demand and inflation makes sense, but I think it makes more sense as a trade than the reality that's going to create inflation. In fact, just consider, for example, my rubber band thesis, that a lot of companies are willing to provide substantially more goods and services, and they have excess capacity, which could actually absorb a greater increase in demand. And one of the easiest places you could see this is by looking at the chip sector. You've got companies like Micron, Western Digital, the South Korea, I can't pronounce this one, but it's like Hynix, all of them, including Samsung, they're all lowering their output because they're seeing massive deflation in the chip sector, specifically in memory. Companies like Intel got out of memory. Companies like NVIDIA have much less exposure to memory, more exposure to GPUs and servers. AMD has a little bit more exposure to the PC market, so we might see a hit there when AMD reports. But the point is, you have a lot of potential excess capacity at a lot of companies throughout the world. We've hired substantially to make sure that when people want to spend, we're able to absorb their spending. So that's something that could put a lid on Chinese inflation, also considering the fact that Chinese excess savings are only about $500 per person relative to the excess savings that we had in America after the COVID lockdowns ended of about $6,000 per person. That's a massive difference of about 12 times per person of a difference. So substantially less of an inflationary catalyst, I believe, in China. But it's something that individuals are still concerned about. And look, Spain's miss to the upside is a red flag. On top of that, you also have what some folks call the tinderbox time bomb that we might face. The hedge fund advisor, who advised the author of the book The Black Swan, Nassim Taleb, he suggests so in other words, the author who advises hedge funds, let's get that clear, and authored the book The Black Swan, is providing a substantial warning that it's not just a second chapter of inflation that could really hurt, even if it's just sort of temporary misses to the upside, but it's also that ballooning debts across global markets could end up wreaking havoc on our markets. And he suggests that the greatest tinderbox time bomb in financial history is all of the debt that countries like the United States have accumulated through the COVID pandemic. And he suggests that if the credit bubble pops, because maybe we hit a second wave of inflation and then the credit bubble pops, we could end up seeing a financial crisis substantially worse than the Great Depression of the late 1920s. that we are going to see the most catastrophic market failure that anyone has ever in their lifetimes read about. And in his warning, he says corrections were once natural and healthy in economies, but now a correction of the magnitude of the debt cycle correction that we need, he argues, could create or become a, quote, contagious inferno capable of destroying the system entirely. That the world is just too leveraged today, that the debt construct is just too big. That's scary. Those are some scary phrases and scary words. So this is why this sort of second phase or second wave of inflation is leaving a lot of people very nervous. Even Paul Krugman, who believes that disinflation is coming, he's a New York Times writer. A lot of people don't like him. A lot of people do like him. He's an economist. He says that, look, even though his base case is inflation coming down, there could be a self-denying prophecy that could end up reigniting inflation. Now, this is really weird because usually we hear the word self-fulfilling prophecy is usually what we hear. But a self-denying prophecy is basically one where we say, look, it is not a problem to worry about inflation because inflation's already trending down. There won't be a second wave of inflation. Michael Burry will be wrong. And look, too many companies like Whole Foods, Procter & Gamble, Johnson & Johnson, Whirlpool are all suggesting that we should see disinflation by the second half of 2023. So we're good. Well, Paul Krugman says that if ultimately we deny the potential for inflation, then we could reignite inflation by just starting to spend again and not worry that the Federal Reserve is going to crimp us and to crimp inflation out. And this is why I think the Federal Reserve is going to be forced to keep sort of that hard face on to make sure that inflation doesn't get out of control and financial conditions do remain at least somewhat tight to prevent inflation from reigniting. So far, though, the data suggests that a lot of this could just be fear, uncertainty, and doubt. Consider again, retail purchases have fallen for 3 out of the 4 last months. Spending on services, rent, haircuts, and the bulk of this sort of services style inflation was flat in December. Now, what we also see is that really consumers, especially poorer ones, are being forced to pull back on overall spending as well, not just services inflation or services-based spending. We also know that ultimately, as unemployment starts rising, the number of spending we expect to see should plummet. And that is what we are also seeing as a potential catalyst for the bottom of the market. Now, this is an interesting one. There's an argument that industrial layoffs, this is a report put together by RBC's head of equity research, as reported via Barron's. This report by RBC suggests that one of the ways that we can determine where the bottom of the market is when we look at a spike in industrial layoffs. Now, this is interesting because Dow Chemicals and 3M just reported that they're both starting to trim their workforces. Dow Chemicals just reported 2,000 layoffs, and RBC's head of equity research suggests that industrial layoffs are one of the best indicators we can pay attention to suggest that a recession is either already here or around the corner. And generally, we know this, stocks tend to bottom when the recession begins because stocks tend to pull us out of a recession. In fact, what they've done is they've looked at the last 2 recessions and they suggested that, ignoring COVID, they suggested that the dot-com bubble low of the stock market coincided with a peak in industrial job losses. They also suggested that the Great Recession low came right after a peak in industrial job losses. And they see that happening now as well. So, personally, trying to put all of this together, you've got hawkish folks at the Fed, you've got bearish folks at the Fed, you've got Lael Brainard suggesting, look, there are lagging effects we have to pay attention to. We've probably got to cut here eventually, or at least pause. Bloomberg on their front page suggests that the Fed points towards a pause in May once hikes have time to sink in, which would basically price in 25 basis points for February. That's pretty much guaranteed for tomorrow, and another 25 basis point hike potentially in March. But let's try to put all of this information together, because all of this is obviously spawned by, yes, an ECI report that has turned indices positive, which is fantastic. But what do we want to pay attention to as investors? Well, in my opinion, to string all of this data we just got on inflation together, my strong opinion is that the best thing we can do is be patient. Be very, very patient, because I believe we are going through a Nike swoosh style recovery in the stock market. I do not believe we are getting a V-shaped recovery like we got after the COVID pandemic. I think we are going to go through a Nike swoosh, very slow and steady recovery in this market, and I believe that we are already off the bottom. However, I believe there are going to be plenty of opportunities in these sort of joscillations here, these oscillations, to basically buy the dip on individual companies that you're trying to increase your exposure to. My favorite kind of companies to increase my exposure to are companies that I believe have long-term innovative pricing power. Pricing power being defined as something that over the next decade, certainly over the next 5 years, have the ability to sell hardware at higher margins, to sell software at higher margins. However, companies that are also limited to being able to or limiting myself to companies that also have the ability to survive during a recessionary environment. So companies that have high free cash flow, right? Low debt relative to the cash they have. And sort of these innovative plays, whether they are ASML, a company that has a 90% market share stranglehold on the advanced chip manufacturing equipment sector, whether it's potentially a bet on Taiwan Semiconductors and even maybe a hedge of Intel against Taiwan Semiconductors. Yes, I know Intel, which got out of the memory chip business a few years ago, and their valuation has plummeted because their earnings have been terrible. Intel's roadmap for actually competing under the CHIPS Act with massive subsidies to actually buy equipment from Taiwan Semiconductors and manufacture it as their own manufacturing facility or within their own manufacturing facilities in the United States is actually very impressive roadmap. And they probably will be a substantial competitor to Taiwan Semiconductors in the future. But these are sort of chip companies, in my opinion, substantial pricing power, specifically amongst Taiwan Semiconductors, NVIDIA, and ASML. Phenomenal pricing power. You could look at a company like Tesla to say, relative to being within their own industry, highest amount of pricing power for vehicles, and then the potential software throughput. One of the big dangers of only investing in software, though, is that you end up with companies that are losing money or are free cash flow negative, which I think is a very dangerous investment to make during a recession, especially during what I think will be a very sort of bumpy road out of here. So my belief is, and then of course you have the energy sector, which would be companies like Enphase. I think dip opportunities are opportunities to add, even though they could be in a downward trajectory, which I've been calling for over a year, that as residential spending declines, these companies will probably see declines. But companies like SolarEdge or Enphase, which have very, very high margins on their inverter businesses, but are also part of a highly subsidized industry, are part of the green energy trend, and have high margin and have pricing power for their products. These are, in my opinion, companies that we want to be paying attention to. Now, I obviously am not here to give you personal financial advice for your portfolio, even though I am a licensed financial advisor, and I run an actively managed ETF, and I sell programs on building your wealth and sort of fundamental analysis, technical analysis, whatever. My thesis is that through this fear, all of this fear, uncertainty, and doubt that will probably continue for the first half of 2023, I think the stock market is poised to slowly trend up with a lot of sort of trepidation in the meantime. So I think there'll be plenty of opportunity to sort of add to positions slowly. I don't think you have to be very aggressive, and I also don't think that you want to be all cash right now. I think you should have probably already started allocating. But I don't think we're in sort of an environment where it makes sense to YOLO margin. I don't think we're anywhere close to YOLOing margin. As much as I would like to go back to those 2020 days, I would personally advocate for staying away from YOLOing margin. Anyway, those are my thoughts on inflation, the employment cost index report, and again, very clear expectation that the Federal Reserve is going for a 25 BP hike tomorrow. But the most important thing is going to be that outlook. Obviously, I will be covering it live, so I encourage you to be here when I cover the FOMC meeting live. We'll be going live at 11 Pacific time for the statement, where we'll get the 25 BP hike, and then we will be going. I'll continue to be live for the press conference, which begins at 11:30, which is where Jerome Powell will provide his remarks. So I hope to see you there.